Hi traders, welcome back to the channel. So you know when volatility is rocking, the risk manager's phone is going to be ringing off the hook. You know, it's been a wild run and quite honestly, a little challenging to say the least. I got a lot of traders saying, hey, you know, Mike, what's going on? What can I do? You know, I even, got some traders who maybe, tested their risk of ruin. There's a lot of core risk management principles that need to come into play. And we've talked about that in the channel, and we could do more videos on that as well. All right, so after the struggling part, it really comes down to the question is, Mike, do you have a strategy that you use in volatile markets? As if almost it's like segmented. My answer is, I really don't have a specific strategy for volatile markets. I'm sorry to tell you that, but I have a strategy that I use all the time in all kind of markets. And honestly, it works really well, keeps me out of danger. And actually it's been performing fairly consistently throughout these volatile markets. It kind of weeds out the noise. So why don't I show you? And better yet, why don't I go down? Let's go down to my office and I'll give you the visuals and walk you through the exact setup, the entry, the trigger. It has its quirks. May not be for everyone, but it's been working for me for 14 years consistently, and I'm not gonna change a thing. Let's go down and check it out.
All right, so let's take a look at this particular chart on TradingView. We're using the S&P ES mini contract. This is, if you're looking at it with your own charts, this is a 60-minute on February 20th, right? 24-hour H contract on the S&P minis, all right? And I'm using a 60-minute. The preferred, or sites preferred, my default is a 60 minutes, but I use this strategy in scalping. I use it for even daily, and I know I have some members overseas who use it on a weekly for their sort of retirement account. So, but we're using a 60-minute here. It's a nice default for me. It's kind of like my sweet spot. So if we look here, all right, we have two lines, right? Two moving averages. One is the 9 period. Another period is the 30. All right. I know some traders use 821. That's like the magic, the magic Maz and stuff. That's fine too. All right. You're just going to have a little more noise and a little more sensitivity, but I've just always used the 930, and I kind of, it's been working, so I never really change it. All right. So we're looking for price action to trigger a potential long or short. And what that trigger is when the moving averages cross. Now remember, it's not a moving average cross strategy, but when they cross, particularly the 9 will cross obviously over the 30 because it's more sensitive. And we're looking for a bar that prints lower or higher than the previous 50 bars. All right. All right. And I'll show you how you can visually see that in a second. So in this case, it met that criteria. All right. And I'll tell you how I come about that. And now once that triggers, and I have a little indicator here that kind of shows a visual dot to show that I don't have to go counting bars and things like that. But once that prints, okay, so my bias is I'm only going to be taking shorts here, right? If anything. So what I want to do is I'm going to set an order at the 30 moving average for a short entry, all right? It's not a wait till it confirm, not rate the bar, not an engulfing candle, not the break of the bar of the break of the bar, the break of the bar, close, then go short. It's at the 30 moving average. All right, we want to get a really good entry price, at least at that time, because we're anticipating it's going to continue. We're just looking for that bounce back to sort of get the sale at the store. All right, so we're going to go short right here. All right. And as you can see, price just muddles along, very, very common, right? And then eventually breaks down. All right, there in essence is the sort of crux of the strategy in action. All right. Default stops is you want to go at the prior swing high in this case. All right. So you can go back and see even off screen, but I'll show you another example where you can see that. All right. And then as far as targets, again, there's so many ways to take targets. There's no really default answer, but default answer of 1-to-1 or 2-to-1. So if you have one target, 1-to-1, 2-to-1 on your target. So you know where your stop is. The stop is going to be at minimum behind the prior swing, all right, and major swing. And I'll show you how that works in a second. So I'm just trying to show the sort of mechanics of this particular strategy, all right? And you got to wait till it play out. Don't worry about any crosses or anything like that while it's going on. You really have pretty much for the most part, at least as far as the default settings, a set it and forget it type trade. All right. Targets. Okay, we're going to go with a 1-to-1 and 2-to-1, like I mentioned earlier. Okay, those are the defaults. All right, there's a lot of ways to play this game. Once you're sort of in a profit zone, especially if it breaches that prior low, all right, now you can start adjusting risk and things like that. I tend to keep it again as a default 1-to-1, which my target is right there, all right, at that swing, and then a 2-to-1, whichever is greater. All right. So again, you could play around with it a little bit. I like to be a little more aggressive, probably for my own detriment, by taking some off the table. That's just my trading style, and then I kind of just like set it and forget it. As far as risk, again, default, you can move your stop to break even. I am not a break even stop kind of person. I think it's just I'm not sure where that was invented, but I will creep up my stop and reduce my risk as I'm in profit, to where I'll have an overall loss or break even on the trade, not necessarily that particular first half. So if I get that off over here, right, I have half left, I'm not moving my stop to break even. All right, I'll nudge it closer to where the entire trade would be a break even. That's just me. I like to give it more room. That's just the way I like to play it. All right, that's the crux of it. Now, if we look here, if we take a target 1, target 2, right, if you opt to trail, and there's certain opportunities that may involve trailing, this actually worked out really nice, right? You have you see these little red bars and the dots keep going, right? So you have opportunities for really nice runners. Do they work? Sure, they work 100% of the time when they work. They could be home runs, and kind of just like one good trade, all you need is 3 or 4 of those a year, and you're in really good shape. Remember, this is the S&P on this particular example, and this happened in February when the initial breakdown started occurring. Just alone was about 160 points on the screen. Obviously it continued. So that gives you a pretty much a sort of simple idea of the mechanics of it. All right, let's look at another example, and we'll get a little more focused on the stops and targets. Okay, so here's another example. I'm using the S&P, same contract, actually going a few days before this on February 14th. All right, so we have a nice rally, right? Printing these dots, and I'll show you how to get those in a second. Right, printing 50 bars, the highest of the last 50 bars. All right, so it's creating a scenario where our trigger is now to go long. Now the question is, where do we go long? We're going to go long at the 30 moving average, if it even gets there. So we're waiting for a pullback. All right, right to 30 moving average, and there's your long entry here. Where's our stop? Yes, all the way back below here. Okay, below this area as well. So you have a pretty nice size range. Right, now obviously really good profit potential if you're going 1-to-1 risk reward, but there's a decent amount of range there. If that doesn't meet your criteria, your risk management criteria, it's not eligible for the trade, just because the mechanics of the trader setting up. And I find this to be a big challenge with a lot of traders. Well, it triggered an entry. Well, it may have triggered an entry on the strategy, but did it trigger an entry on your trading rules, on your risk management part of your trading plan? Right, if you're going to expose yourself to, say, 80 points of S&P risk, 2 things got to happen. You have to either reduce your size or just pass it up. Say, I'm not going to take trades where the exposure is more than 40 points. All right, simple as that. So this is a big mistake I see a lot of traders doing. Just because it triggered doesn't mean it's an automatic trade. It has to meet your trading plan requirements. All right, but your stop would be there. One of the biggest fallacies is people say, well, I don't want to take that much risk. I'm going to put my stop, say, over here or some random place. And they get tagged out, and then it goes in their favor. So that's the problem that I see a lot. So make sure you don't do it. The rules are the rules, and if they don't qualify, you could pass on it. There's plenty of opportunities with this type of setup. I mean, it's just price movement, moving averages. So it's you'll have plenty of opportunities in different products and even stocks. I mean, they're phenomenal with that as well. All right, so we have our long entry. All right, where's our first target? We're going to break of the high, or if you want to do 1-to-1, that's fine. So it would be the measure move from here to here, and then just go and measure move ups, which is obviously pretty far distance. This would be a monster trade. All right, but that's the mechanics of it, right? If you set your first target over here, that's fine. Notice I'm giving a lot of flexibility. The strategy lends to that to be able to do it, and there's a lot of other variables that play into it. Could be bigger picture things, quirky nuances that we have. We have market context. Those are some of the things you have to develop and we do in our training here at at the Desire to Trade. So some of the things you want to consider, but the basic crux of it is this thing. It's a relatively simple strategy. All right. The question is execution, and also sticking your nose in here. Don't wait for confirmation, and then you're entering over here. Okay. Chances are you may have a winning trade, but you're going to suffer a lot of heat. All right. We want to kind of get that sale price and kind of take a stand. That 30 moving average is our confirmation. All right. And that's what makes it so difficult. That's what the sort of difficulty is in this particular strategy. All right. People thinking like, if it doesn't go in their way right away or it starts tanking, well, we'll look at how we get out of trades in a second. All right. So in this case, if we had a 1-to-1 risk reward, right, we'd still be in the trade. Right. If we took our target here, at least the first part, we're out at half or whatever, partial that you have over here as well. All right. So you're going to hang in there. So just say you had a 1-to-1 risk reward. All right. And you're still in this trade. So it's working out pretty good. All right. Until what do we have here? All right. We have price come down, peg. This bar broke the previous 50 bars low. All right. And it plotted a little dot here. Okay. So it's visually easy for me to see. So now I have to go into exit mode. All right. This trade, in essence, really didn't work out. All right. It's going to happen a lot of times. You get a lot of this chop with any type of trend-based strategy. It just doesn't have enough buyers to bring it to the promised land. All right. Very, very, very normal. So what are we going to do about it? Our exit rules is we have our room, we have our stop below there, right? And what we're going to do is we're going to wait for price. If it does, we're so blessed to go back to the 30 moving average, and then we're going to get out over there. All right. This is a key component to the overall math of the strategy. Those who bail out as soon as I see a red dot and they get over here, it ruins the entire profit margin. All right. And this has been going back testing live for 14 years. All right. I'm telling you, the entire profit margin is screwed up. So that's why it's difficult. It's easy strategy, but it's difficult to manage because it kind of hits a lot of discomfort zones especially for a lot of the newer traders. But once you become consistent and profitable, you understand the mechanics of profitability, of holding, and that's why patience is such a big thing. So here is, quote unquote, a trade that didn't work out. All right. So where did we get in? Let's look at I'll show my line here. All right. 61.25. All right. We got in right here. Let's go 61.26. All right. We're going to see that. Started to work. All right. You had a 1-to-1, so you still have your size. Right. If you took some off, that's even better. But let's say you didn't. Worst case scenario. And we're going to get out at 30 right here. What price is that? 61.44, 61.43, somewhere around there. All right. So what am I showing here? We got in at 61.25 and we got out at 61.44, something like that. All right. That's the beauty of this strategy. All right. That's the beauty of the mechanics of it. It doesn't necessarily have to work out for you to have a winning trade. In fact, a lot of these type scenarios, you will have quote trades that didn't work out and you'll have break even or slight losses. It's those slight losses that allow you to stay in the game, and then you have to have a few wins and they more than make up for the small losses. All right. Are you going to have full stop outs? Yes. Let's take a look and see where it would be a stop out. This is real trading. Okay. You are going to have full stop outs. Let's take a look and see. You don't have to go too far to find them, let's say. All right, perfect example. Just, this is a 60-minute chart, so about 12 hours later, okay? We have a long trade right here, right? Here's the 30 moving average, 61.50. I'm not sure what exactly that was. Celebration because we entered. I don't know. I'm not a really big TradingView fan, so bear with me. 61.50, give or take, right? And immediately seems to be struggling, right? Don't worry about the crosses, right? They don't mean anything after you enter, right? And here we go. Big down move, all right? Someone argues stop would be here. I like to have the pivot low. That you want to give yourself some room, okay? I know sometimes that's a lot of size for a lot of people, a lot of room to put your stop. This isn't a strategy where you just want to jam your stop below like the previous bar or something. You can do it, but it's just not this strategy, right? The key to this is you want to give yourself room to get out of a jam. And this is in exactly the same point, right? You have a reversal signal. So you have these red dots below, these shorts. Now you actually want to think about going short, all right? But you're long. So you go into sort of exit mode, all right? You're going to wait for price to go back to the 30 and you're going to get out over here. Where's that price? 61.37, right? Give or take. Where was our entry? 61, what did I say? 61.50, 61.48, something like that. So you see what you did? You had a partial loss on a trade that clearly didn't work out pretty much from the onset. All right. Now, is this a setup for everyone? It's up to you. That's what the strategy calls for. It has a positive alpha and a positive profit margin of about 1.3. For a very, very 14 years of trading. All right. So this is the key. This is sort of the secret sauce, and we'll summarize this in a second, but this is sort of the secret sauce to the strategy, is those partial losses. You will have losses, you will have full stop outs, but the key is to have partial losses. Those really aren't a problem, and then you have some winning trades and they'll make up for it. Let's take a look at a scalp trade. So in fact, I even had one this morning. We'll see, and we'll go through that right now. Okay, here's an example of a short trade, short scalp I took earlier this morning, right? And I'm always a little weary about that opening drive, that first 45 minutes up. The sweet spot, by the way, of this strategy I found is around that 9:45, 10 a.m. Eastern, so 15 to 20 minutes after that initial digestion when the market, the New York Stock Exchange opens, and I take it to around the London close. Those are sort of like my sweet spot. Around lunchtime, things start to get a little choppy normally, right? And then the afternoon, power hour is actually pretty good too, but you can get a lot of whipsos there as well. But it does seem to be a little more turbocharged and stay away from the sort of lunchtime chop. So that's my sweet. And that's been, by the way, power hour and also that first like sort of hour and first hour 45 minutes in the morning, barring the first 15 minutes of the market, U.S. market open, has been the sweet spot and better profit margin performance, almost every year for the last 14 years. So I'm sticking with that. So we have here, we have the red dots, short, not working out. All right. Here's your blue. So now we know we're going to go long. All right. Pull back down. Here's the 30 moving average at 56.40.25. I think I got 56.40.50, something like that. All right. And immediately, again, these are 5-minute bars. So this is nothing. I have my stop below here. All right. Come up here. Looks like it's working. Failure. Not a big deal. Rallies back up and starts printing. So I'm peeling off right over here. And in scalping, for me, my personal thing is to take full size. All right. Especially in the beginning, in the beginning of the day, things can really be whipsawed. I'm just going to take my profit. And here it was a 56.47. It was about 7 points on the trade. Took some heat, very normal. All right. Had my stop outs if I needed to, but it worked out. Notice again, the moving averages crossed. They mean absolutely nothing. You're following these dots, so to speak. But in a case like this, you had to be patient, all right? You had to probably walk away from the screen if you had to. So you go here, and then if I trailed, I would have been stop out, probably, break even or overall break even on the trade, all right? But in scalping, I usually like to, especially in the beginning, I like to take my green and go. And as you can see, right, this was sort of a profit zone for me. Took the profits, got in, and I looked at it eventually, would have got you out. And here's a great example, right? Your stop is below over here, right? Around 56.12, something like that. Price came crashing all the way down here. People start bailing. What happens? Price runs up and you get out right here at the 30 and was nice enough to kiss the 30, right? Those are sweet exits. And sometimes they happen, sometimes they don't. That's why I have full stop outs, all right? This was at 56.40. So just say this didn't happen. You just held it the whole way. What was our entry? About 56.40, right? Came all the way crashing down, came up, and you got out at 56.40. So we're about to break even, maybe a small loss, maybe even a couple tick gain, whatever the case may be. But this room here gave you areas to get out, right? Hoping for that bounce. If not continued, then you'd have your full stop out. And that happens, again, between 14, 16%, on really bad months, 20, 21%. Some of the high vol, we're starting to see pressures more towards 20%, but very, very controllable because the winners will certainly take care of it too. But it's those small losses that really make this strategy. Again, we'll wrap it up in a second, but what's the key to this whole thing and why do traders seem to have trouble with successes? They move their stop. They don't want to give themselves that much room. And I understand it. This isn't a strategy for everyone, right? But the key is to give yourself some room to get out of a jam, right? That's the key to this strategy.
All right, so I hope you got some information out of that to help you at least start the process. Again, play around with it, trade it in demo. Just don't start loading size here just because you watch the YouTube video on strategy, right? It takes a while to develop that muscle, particularly when the trade goes against you. So let's go over some of the core things I want to make sure you understand before you get your feet wet into this trend-based strategy. One, it's a trend-based strategy. A lot of people love to follow the trends. I get it. All right. Half my trades are reversion, but when it comes to trend trading, this is my go-to baby. All right. Very relatively easy, I think, to identify. Doesn't have a lot of stuff on the screen, and very easy to identify and where your entry point is. All right. You have plenty of time to get in. You know where it's coming. So I love that part of it. Second, this is my default strategy when I just can't find a trade. I don't want to start probing and sort of like looking for trades. But when I'm traveling and nothing else is happening, I'll just go to this go-to and see if I can find an entry. There's usually an entry somewhere. Some markets are trending somewhere. So, and usually this strategy will pick it up. All right, the other cool thing, really good for swing trading. I have retirement clients using this in their retirement funds on the weekly charts, but I also have scalpers using it on the 3 to 5 minute, all right? You have to have your risk management like we talked about, but I love the versatility of this strategy, right? So keep that in mind. It's a one-size-fits-all type strategy, and that's what's cool, and that's what's attracted a lot of our members to trade this strategy. All right, and the added boost, all right? The juice, add a confluence layer. I personally use VWAP as my target. So a lot of the traders use VWAP to play the bounces. I'm using VWAP as my target. So instead of that first one being that, sort of getting back to the high, and then the second target maybe going, to an extent that, I want VWAP to minimum be my first or final target. That's my sort of secret sauce confluence. You could find your own. There's plenty of other ones, but I find it to be my personal secret sauce. All right, next. You shouldn't get too much heat if you're trading this type of methodology and strategy in a prop challenge. I use it myself personally, teach my students and members the desire to trade this strategy, and it's also working fine on our managed side as well. So you're not going to get too much heat in that regard. All right, now a little advanced tip we won't go into today, but if you understand the concepts of market context, knowing where you are in relation to where the market's positioning itself, how long a run it's been, things like that, you have a little bit of an extra edge. But that's a different, more advanced topic for another day. But keep in mind that it's not just moving average crosses and firing bullets. There's certain times where we want to push it and certain times where you don't want to do that. Most important today is to understand the core basics and framework of the strategy. All right, so let's go over some of the caveats here, right? Really, really important. First and foremost, and I really don't want to see, come on, let's eliminate the comments here about the crosses. This is not a moving average cross strategy, nor is it a moving average cross slot machine, all right? When we first start teaching this, I get a lot of, the cross here, cross there. Don't worry about the crosses. In fact, the 9-period EMA, you don't even really need it, to be honest with you. It just gives you a visual peek of where things are turning, where it gives you your bias, all right? But really, don't worry about the crosses too much. People use that as sort of the crux, like it's a moving average cross machine. Wrong, wrong, wrong. Guaranteed you'll fail at this strategy if you do that. Number 2, patience. If you'll notice, price has to come down and revert to that 30 moving average, right, for you to enter. It takes a lot of patience. It takes a lot of waiting, right? People don't like to wait. That's what I find. They take breakouts and things like that, or they start switching it up, all right? Wrong, you're not going to get the price that you want to, especially if you're wrong. You want to have that good entry so you can get out of it either at a break even, small loss, or even if it's a full stop out, it's not going to be something that will crush you. All right, next, win rate. I know everybody loves a high win rate. All right, this one, average, probably around 60%, 57%, sometimes 63%. All right, the key is not about the win rate because a lot of those wins are going to be partial wins, right? It's going to go against you and you're going to get out on the bounce into the 30, all right? Partial wins, break evens, things like that. You may have some home runs, but that's really if you trail, and that would be very selectively. So keep that in mind. It's kind of like a boring, churning type strategy, but it kind of produces sort of tenant income in a sense. You know, we have rental income from a house, all right? It's not exactly the highest sizzle, but it'll be consistent, and you won't have those big, huge losses that you'll see in other types of strategies. All right, it does tend to be a little choppy in boring, choppy range markets, all right? It's generally a trend-based strategy. Now, you could have a 5-minute chart and, you know, this trend could be just like, you know, a morning run or something like that. So it doesn't have to be in a, quote, big time trending markets. However, it does tend to chop up a little bit, but that's the beauty of the strategy where it gets you out either at small losses or break even during those times. And of course, when things start to trend, it really kind of kicks it into high gear. But some traders, you know, they don't like that. And by all means, certain rules, I have some where you eliminate the type of rules into the strategy during choppy markets. I'm going to pass on it and maybe go to other strategies, take advantage of sort of options, premium selling, collect some rental income, and then wait for the trend to resume and then hit it big time. And most importantly, and we talked about this in the video, exit rules, right? The biggest mistake I see traders do is when the trade starts to fail, they bail out, all right? They put a stop below the low of a bar or things like that. The beauty of this strategy is, and also the caveat, right? That stop may be a little far for some people, right? You want to give the trade time to work, to bounce so you can get out of it, all right? The full stop out rate should only be around 14, 16%. On a really bad month, 20, 22%, all right? What reason that is because you're giving it time for you to get out at a small loss. A lot of traders bail and say, it's not working, I'm getting out, right? Usually before where the stop is. Or they put their own rules and put tighter stops, which is really destroying the entire methodology to begin with. So, you know, if you do that, that's fine. It's just not using the strategy. So, you know, beware. I see that a lot and it kills the profit margins. So the secret sauce is those exit rules, all right? Allowing the trade to get out when it goes against you at a relatively small loss. Does it happen all the time? No, that's what trading. That's why you have stop losses order in place. Those small losses are going to be very small in relation to the wins that you have. If you have full stop outs all the time or you bail out, now you need a really good trade to kind of break even, get that back. But if you have a lot of small losses, all you need is 1 or 2 nice winners and, you know, you're back in the game. That's the key, that's the secret sauce, and that's the area that I see violated the most. And your key metric, now I don't even follow win-loss anymore on this, all right? I've been doing this for 14 years. It's going to be about the high 50s, low to mid 60s. You know, if you use certain really cool market context rules and some confluence like VWAP, you'll probably get into the sort of, you know, middle 60s range. However, the key metric to this entire strategy is that full stop out rate, all right? You want to see your results. They should be around mid-teens, all right? So 14, 16%. A lot of this is sort of a conservative approach during volatile markets, which is going to give me some green, but not necessarily going to blow me out of the water as far as profit margins, all right? It's not going to have the big home run type months, unless I trail on a big month, which happened actually this month. But those are rare. Keep it simple and really monitor that stop out rate, that full stop out rate. That's the measure that you want to see in your journal. And if it's too high, look to see what you're doing, all right? Maybe you're taking those stops too early. Maybe you're not putting your stop where it should be, all right? You should have very relatively small full stop out rates with a lot of losses that are partial. All right, so I hope you got something out of this. Maybe it's a new strategy that you can put in your arsenal. Again, practice and demo. It took me a while to get a hold of this one, and it's been my baby for over 14 years, and I think I'm just going to be trading it the rest of my life. All right. Also, I mentioned in the video that after a certain number of bars, there's a dot that plots, right? It's much easier on the eyes. If you want that, also click on the link below. I'll give you the TradingView code for that as well. All right, just compliments from me. All right, enjoy it. It's been great for me. I hope it is for you, and we'll see you next time.